All right, let's get right into it. Today, we're tackling something that can give any Canadian investor a serious headache. What actually happens when you accidentally put too much money into your TFSA?
So, did you do it? It's a mistake that is surprisingly easy to make. Maybe you lost track, or you were just a little too excited about saving. But hey, if you're here, you probably know this isn't a small oops. The consequences can be pretty costly if you don't move fast.
So let's just cut right to the chase. The single most important number you need to burn into your memory is this one, 1%.
What does that mean? Well, it means you're going to get taxed 1% on every single dollar you've overcontributed. And listen, this is not a one-time penalty. It's a tax that gets charged every single month that extra money is sitting in your account. Just think about it for a second. An extra $5,000 in your account will cost you $50 a month, every month until you sort it out. That adds up fast.
Okay, so let's break this down. Let's really dig in to what the Canada Revenue Agency, the CRA, officially calls the 1% overcontribution penalty. Getting a handle on this is absolutely the key to not paying more than you have to.
First things first, what exactly is an excess amount? It's actually defined really simply. It's any money, any funds at all sitting in your TFSA that puts you over your official contribution limit for the year. That's it.
And look, this isn't just our interpretation. This is the official rule, straight from the source. The wording is crystal clear, there's no wiggle room. Any excess amount is taxable at 1% per month for as long as it remains in your account. Yeah, there is zero ambiguity there.
Now, you're probably thinking, okay, but if I overcontribute, the CRA will just tell me, right? They'll send me a notification. Well, yeah, they will, eventually, but there is a huge catch here, and it's something called the reporting delay.
So here's how that delay actually plays out in the real world. Let's say you make your contribution late in the year. Your bank, they don't actually have to report that data to the CRA until the end of February of the next year. Then the CRA has to process all that information, which usually takes them until about April. So what's the result? You might not get that official letter in the mail until late spring or even the summer.
And this is the most important part of this whole section. You could be racking up that 1% monthly penalty for January, February, March, April, all without even having a clue you have a problem. The responsibility to track your own contributions in real time, that falls 100% on you.
Okay, so that's the problem. But here's the good news. If you realize you've gone over your limit, there is a clear, super straightforward way to fix it. So here's your two-step action plan to get this sorted out, and fast.
There are two things you absolutely have to do. First, get that excess money out of there. Immediately. The second you realize your mistake, withdraw those funds. Second, and this is so critical, you still have to file a very specific form with the CRA called a TFSA return. Taking the money out stops the bleeding, but you have to formally report the time you are over the limit.
And honestly, this is probably the most important piece of advice in this entire explainer. Do not wait for the CRA to contact you. The instant you take action is the instant that 1% monthly tax clock stops ticking. You have got to be proactive here to minimize the damage.
Okay, so you've taken care of those two essential steps. What happens next? Let's just quickly clarify who is responsible for what between you, your financial institution, and the CRA.
This table lays it out nice and simple. Your job, withdraw the money and file that TFSA return. That's it. You don't even have to call your bank. They'll automatically send the record of your withdrawal over to the CRA. From there, the CRA processes everything and will likely send you an official notice or a notice of assessment later in the summer to settle up any tax you owe.
And just a quick note, for anyone who might be a non-resident of Canada, for you, the process is a bit more direct. The CRA will just send you a notice of assessment. It'll clearly detail the overcontribution and give you a straight-up calculation of the tax you have to pay.
So, you fixed the problem. Now the big question is, how do you make sure this never, ever happens again? This last part is all about prevention.
And you know what? It all comes down to one golden rule, which we see right here. It is important to keep and maintain your own records and to track your contributions closely. This right here is the absolute key to managing your TFSA properly.
So why not just rely on your My Account page on the CRA website? Well, because that's a pretty risky strategy. Think of it like this. The CRA's website is always looking in the rearview mirror because of that reporting lag we talked about. Your contribution info for 2025 won't be fully updated on their end until April of 2026.
Your own records, whether that's a spreadsheet or just a simple notebook, that is the only 100% accurate up-to-the-minute source of truth for where you stand.
Ultimately, it all just boils down to this. Your tax-free savings account is one of the most powerful tools you have to build wealth for your future. So the final question is pretty simple. Are you giving that powerful tool the attention it really deserves?